Hi everyone, Joe Gentile from Sarraf Gentile LLP. In today's video, I want to go through what I regard as a tremendous scandal in the sales and marketing of Index Universal Life, or IUL. I think that there are some really fundamental misrepresentations that are made by carriers in particular as to how these products actually function, how the indexed options actually function. So when you buy a policy, or you're being sold a policy, I should say, you're usually shown illustrations that are showing you or purported to show you how the product actually functions, and sometimes they're not supposed to be, but they're given to people and they're projections as to what the policy could return if these rates of return are hit. And so you're given a general account option or a fixed account option, and let's say that that's being illustrated at a 4% rate of return, which makes sense because that's hinged to what the insurance company is making on their investments, and their investments are largely in high grade bonds, so they're low risk fixed income assets. So a 4% return is reasonable. Then you have the indexed option, and they're showing your potential returns on the indexed options. Now, the indexed option is almost always going to be illustrated at a higher rate. So let's say they illustrate that at 6%. Now, one thing to keep in mind when you select the index option in your IUL, no money is being invested in any index or any equities, nobody's money, not yours, not the insurance companies. What's happening is that 4% that they're showing on the general account or the fixed account, they'll take a portion of that money that you would have gotten if you selected that option, and then they go buy options from a bank in order to create this crediting system hinged to an index where you have a 0% floor and you have these caps or participation rates. So since no money is put in the S&P 500, if let's say you have a cap rate at 10%, the insurance company needs to protect themselves in the event the S&P has a great year, a 30% year return. And the way they do that is by buying options from the bank. Now, when the insurance company is showing you a 4% return for their general account and a 6% return or 6% crediting rate if you choose the indexed option, and again, no money is going into any indexes, they're effectively showing you a 50% rate of return that they're earning by buying these options from a bank every year for the duration of the contract. So if you're 40 years old and they're forecasting out or illustrating out until age 110 or 120, and they're showing you this 4% general account, 6% index the whole way through, they're showing you that they are earning 50% a year. They're able to earn 50% a year by buying options from a bank. This is when you buy options from a bank, it's a zero-sum game. You have the insurance company buying the option and the bank selling the option. So for this relationship, this idea that the insurance company is going to earn these tremendous returns year after year on these options, you have to believe that there's a bank on the other side of this that's selling these options and losing that amount of money year after year after year. It's not going to happen. It's a fantasy. And by putting that out there and by showing that they're able to earn these fantastic returns by buying options, it's just simply false. It's not going to happen. And they're not showing how the product actually works. To make matters worse, not all, but a large percentage of the premium that is sold every year for Index Universal Life is sold through premium financing. So you're getting these illustrations again. The agents are putting these illustrations in front of people, the insurance carrier supporting it, but now you're not just shown that you're going to make an amount of money that's not going to happen. You're also now they're facilitating you borrowing money to buy this policy, with the idea that over time the policy is going to earn enough money to pay back these loans that you're taking out and then still have a death benefit or some positive result at the end of the day. And if that doesn't happen, If the illustrations are off and you fund according to the illustrations, if the insurance company's not making that 50% delta a year, if interest rates go up such that the loans are costing more than the policy is crediting, you could end up losing everything that you put into it. You could end up losing your collateral. You could have more collateral taken. If you're borrowing money through the policy and the policy lapses, you could owe taxes on that. There's a tremendous amount of risk that's put into these premium finance arrangements. And unfortunately, a lot of times they're sold as being pretty safe and being this kind of arbitrage situation where you're going to get free insurance because you're borrowing money at, some percent, and you're going to get a 6% credited return, even though that 6% or 6.5% is, let's just say, generously extremely optimistic. There's no free lunch. That's very unlikely to happen. So I think a lot of people are undersold on the risk, and they're misled as to how the mechanics of the IUL and the crediting actually work. So that causes people to get locked into these very expensive and costly situations sometimes. So I'm not saying that IUL is an evil product and it never works for anybody. That's not true. There's an honest way to present it, and there's an honest way to sell it, and it can work for some people. And I'd say the same thing for premium financing. There are situations where premium financing is appropriate. It makes sense. It can work, but unfortunately, it's not always sold that way. So if you've purchased one of these IUL policies under the assumption that these fantastic rates of return are realistic, or you've gotten into a premium financing arrangement where now you're seeing that it's not quite working out, it's sold, we'd love to talk. We'd love to vet the situation or vet the policy. I think in a lot of these instances, litigation could be a good option. So as always, feel free to reach out if you have any questions. And if this is a topic, the intersection of life insurance and annuities and the law that interests you, I encourage you to subscribe for future videos. Thanks. Have a great day.